everyone, and thank you so much for joining us for week 2 of BFSG's 2022 fall webinar series. Now, let me give it over here to Mr. Paul Horn, a certified financial planner at BFSG, for introductions. Paul.
Hi, everyone. Again, my name is Paul Horn. I'm the senior financial planner with BFSG Wealth Management, CFP myself. I know this year has really been an interesting year. So definitely looks forward to get some expertise today from Marilyn. So Marilyn, can you introduce yourself?
Hello, my name is Marilyn Blank. I'm a CPA. I've been practicing in my own practice for 30 years. And we help small businesses, retirees, large businesses, everything in between, individuals to do tax planning, estate planning, financial planning with the assistance of financial advisors, and looking forward to giving you some insight into this year's taxes.
Thank you so much. All right, guys. So today, a lot of this will be the normal sort of year-end tax planning that we're going to go through. But given that this has not been an ordinary year in the markets, it's been a very volatile year. For most people, it's either been very good or very bad. There hasn't been a lot of in between. So we're going to put a lot of focus on strategies that might help you plan for taxes in a bear market. Chad, can you kick us off with our first poll?
I can. I like it, group. So again, as much as this is a tax planning in a bear market, at the end of the day, it is just tax planning in general too. So let me launch this poll for all of you on the computer or a laptop. It should pop up on your screen right now. Please do submit your answers, one choice. But the question is, when do you normally begin or start tax planning for this year? And with most responses in, let me close polling. And we got actually a pretty good spread. I say we have around a quarter of the people say right around now, about a third say in January, about 11% say right around that tax deadline. I know Paul's going to tell you that that's not really tax planning if you're doing it right at the deadline. Planning, what's planning? About 25% as well, and about 5% say others. So okay. Paul and Marilyn, take it away.
Okay.
All right.
Well, the first thing is, yes, planning needs to happen now. It doesn't do any good on April 15th if we've got suggestions for things that you should have done in 2022 to save taxes. So you really need to plan before December 31st. Once midnight strikes, it's too late for 2022. Yeah. There's a few things you can still do. IRA contributions, retirement contributions that can be done until April 15th and or later up until October 15th or September 15th. But most of it needs to be done now before the end of the year. The big thing right now is looking at whether you need to take required minimum distribution from your IRAs, whether you should make some Roth conversions and make some charitable contributions, open do some charitable giving strategies, do some estate planning strategies by gifting to family members to reduce your estate. And so now's the time to do that. If you have a CPA, you should at least, if you don't do a full projection or a plan, you should at least talk, find out what's different, with taxes, tax laws for 2022. There's not a lot different in 2022. There was a lot different the last 2 years. This year's a little bit smoother and not quite as crazy, at least so far. Obviously today, craziness with the market could change your tax strategies completely. So who knows what's going to happen after today. And there might be gains to take, losses to take, who knows? That's up to Paul. But making those, doing those projections, or again, even just talking or even looking at your tax return that was prepared last year and understanding what tax bracket you're in, what your adjusted gross income is. There's so many things that affect your adjusted gross income, which then affects other things. If your adjusted gross income is too high, you're going to have possibly higher Medicare premiums, less ability to deduct medical expenses, Your AGI could trigger many things. So it's really important that you understand how you can, what it is and how you can reduce it, which in the end will reduce your taxable income.
Yeah, the only thing I would add to that is it's just now is the important time to talk with your financial planner, talk with your tax professional, see what you can do before year end. And you want to have that conversation sometime in late October to through November. And realistically, any transactions you're going to do, like maybe say a Roth conversion strategy, those really need to be submitted by the 1st or 2nd week of December to give your custodian, whether that's Schwab, Fidelity, whoever that is. We just want to make sure that they have enough time to process those transactions before. Look at year-end tax planning strategies. You really can break them down into 4 different buckets. The first bucket is discussing around your investment portfolios, whether it's recognizing the capital gains or losses. We're probably going to want to make some changes on your investments at this point. That could be done either rebalancing, but when you're doing so, we'll make sure that we avoid those wash sale rules, and we'll talk more about what that is. There's retirement planning, making sure that you've put in as much as you can into your retirement plan accounts, that you're maximizing your HSA. We'll talk more about Roth conversions. If you have retirement accounts and you're over 72, making sure you've taken the RMDs. We'll talk more about all that. And then with the income taxes, we'll talk about how to manage your income tax brackets. So there's things that can be done to maybe delay reporting on some income or maybe pull forward some income. I know it sounds kind of counterintuitive saying pay taxes today, but there may be a case or scenario for some of you where that actually may make sense. And we'll get more into that as well. Look at the proper tax withholding. What you don't want to have happen is think that you're withholding enough taxes, get to April and find out you owe the IRS another $3 grand, $5 grand, whatever that number is. So if no other reason to meet with your tax professional, you just want to make sure that you're on track with the withholding that you're doing is matching your projected taxes that you're going to owe come next April. Because if it's not, now you have to pay more money out of pocket, which can be a surprise to some. Then you're also looking at potentially additional penalties and interest as well. And then finally, we'll talk about some charitable gift and legacy planning, whether it's funding 529s, how to maximize your charitable gifting, and how giving to your family may actually help your situation as well.
So there's a handful of things that you have to do before December 31st. That would be charitable giving. You need to decide who you're giving to, how you're giving, how much you're giving. The IRS has increased the standard deduction. So for a married filing jointly couple, the standard deduction is $26,000, which is quite a chunk of a deduction. If you don't have a large amount of mortgage interest, your charitable contributions may not help you a lot. You're automatically going to get that $26,000 standard deduction. And for a couple both over 65, it's going to be almost $29,000. So in charitable giving, you may want to bunch all your deductions in one year and then skip a year. So for instance, contribute in January and then again in December of the same year, and then have a year where you don't make any charitable contributions. That may help you get over that standard deduction amount. Another thing is a lot of people don't take advantage of giving to charity out of their required minimum distribution from their IRA. If you do it that way, you also reduce your adjusted gross income. So instead of having an IRA distribution as taxable gross income and then a charitable contribution deduction, which you may not even get the benefit for, if you take it out of your IRA, you direct your investment advisor to send those checks off to charity out of your required minimum distribution, that will save taxes, that will save, it'll reduce your adjusted gross income. And so that's beneficial. Again, that has to be done before December 31st. And the advisors need time also to be able to process that. So
Yeah,
that should be looked at.
And that's called the qualified charitable distributions, doing the gifting out of your retirement accounts like a 401k or IRA instead of out of cash or stocks.
Correct. Another thing, talking about gifting stocks, you can gift to a charity directly highly appreciated stocks, and you get the deduction for the fair market value of the stock, and you don't have to sell it, pay taxes on a capital gain, and then move that deduction to a charitable deduction. Instead, you just get the charitable deduction for the fair market value of the stocks that you give directly to charity. Again, that takes some lead time for advisors to be able to move that, but that's a very good strategy. A lot of times people don't think of this. They just sell their stocks and then they go, oh, I have money, I'm going to donate to charity. And it would have made a lot more sense from a tax strategy to just move those stocks to the charity. Another thing in terms of, so here's the new tax brackets for 2022. Actually, these are the capital gains rates for 2022. And one of the things that people don't think about is this 3.8% net investment income tax. That applies to interest, dividends, capital gains, and it could hit you. It's an additional tax. There's ways to, you've got to look at your, again, it's all looking at your tax summary, even from last year, understanding your tax bracket, what your taxable income is, what's happening. So a lot of times most people just drop off all their stuff on, April 1st and think magic happens when I tell them, oh, you owe this, you owe that. It's like, what can I do? It's too late. So again, December 31st right now is the time to do this.
So the key here is if you're filing single, if you make more than $200,000, you're going to be subject to this net investment income tax, known as NIIT for short. If you're married and filing jointly, then that triggers at 250,000 is the magic number there, where you have to pay this additional 3.8% on top of your normal rate. Now, if you've had an investment and you've sold it for less than 12 months, so let's say you bought it February of this year and you sold it this month, any gain or loss is what is called a short-term capital gain, because you held the position for less than 12 months. But let's say you bought Apple 2 years ago and sold it in October of this year. Since you held it for longer than 12 months, that is considered long-term capital gains. And long-term capital gains are taxed at these more favorable tax rates. So the highest tax rate on short-term capital gains could actually be 37%, plus that 3.8% net investment income tax, for a total of 40%. Where a long-term gain, the highest rate you're going to pay is 23.8%. So when we are selling investments, we ideally want to try and hold the position unless it's a loss for 12 months or more to take advantage of the long-term capital gains tax rates.
Correct. Also, you will note that you also get the long-term capital gains rate from qualified dividends. So qualified dividends get the preferred long-term capital gains rate. So that's important to look at on the front page of your tax return. There's going to be your total taxable dividends, then your qualified. Those qualified dividends, which is a portion of your total dividends, falls into that long-term capital gains rate. And if you're, as a married filing jointly, if your taxable income is $83,000 or less, and the majority or a good portion of your income is qualified dividends and or long-term capital gains, you may have zero tax to pay. So again, it's why it's really important to look to see what your taxable income is, what your gains are, how your dividends are, and Paul can explain the qualified dividend thing because it's a little complicated and I don't understand it, but it's the way that you hold these stocks that produce dividends.
Yeah, it's based on the length of time that you hold it. So again, just if you hold this, if you buy a stock or a mutual fund or an ETF and you hold it for at least 12 months, the majority of the income produced by that stock will be long-term capital gains. That's the easy way to explain it without getting too technical at this point. If you guys are more savvy in your investment style, just be careful with things like options if you're investing in those. We had one client that did very well in stock options a year ago, made to the tune of about $600,000 in gains from investing in options. And that's a high risk strategy. And the challenge with options is they're all taxed at short-term capital gains rates. And the guy had a great income. So he ended up paying this 40% margin on those gains of 600,000 because how he was investing, he was making money, but he was giving up a lot of it to taxes, unfortunately. So with proper tax planning, you can keep a lot more money in your pocket when you're investing. Now, when we're looking at determining what are short-term or long-term capital gains, it's kind of a process you have to go through to get there. The first thing that you have to do is you have to take all the net long-term and short-term gains. So you're going to take the short-term gains, so everything that you've held for 12 months or less that you made money on, and you're going to subtract the short-term loss. And then you're going to do the same thing for your long-term position. So anything that you held over 1 year, you're going to take the gain, you're going to subtract the gain from the loss. If they're both gains, so you made money at both short and long-term, you're going to pay those taxes at each applicable rate. So the short-term capital gains at ordinary income tax rates, the long-term capital gains at those preferred tax rates, which was at 15 to 23.8%. If you have one loss and one gain, and this is quite possible this year, then what's going to happen is you're going to net those two numbers up. So let's say you have a loss in the short term, but a gain on the long term. You're going to subtract the short-term loss from the long-term gain. Then the amount left over is going to be applied at the appropriate tax rate. And if they're both losses, which is quite potential this year, given how the market has performed, being that we are in a bear market, what you do is you're going to add up both of those losses. You can take $3,000 from your losses. So let's say you have a short-term loss of 10,000, a long-term loss of 15,000. So your total loss this year is 25,000 in that example. You can take 3,000 of that, reduce the loss from 25,000 to 22,000, and that 3,000 can be used to offset your income for the year. So if you make 100,000, now your taxable income becomes 97,000 in this example. And then those 22,000 of loss in that example, you don't just lose them. They become what are called loss carry forwards. So you can use those losses against gains in future years. So in a year like this, a really valuable strategy is what's called tax loss harvesting. So if you have losses in your portfolio and you want to lock in those losses to take advantage of being able to take those losses against future income, it's really good strategy to do that. You know, a good example is maybe you have Coca-Cola and you like the position, but you have a loss in it. Maybe you sell Coke and buy Pepsi instead. So there's some rules around this where you can't sell a stock and buy the exact same stock tomorrow. You have what's called a wash sale rule of 30 days. So you have to hold that position for 30 days before buying the same position. Another strategy from an investment perspective that is very beneficial in a bear market is called resetting your cost basis. So for example, let's say you bought Tesla a few years ago at a low cost basis, and let's say you've made money on it. What you could do is sell the stock now. Let's say you bought it, $30 a share, and you're able to reset the cost basis on that. What you can do is you can sell the stock, you pay the taxes, you take the capital gains there, and we want to offset those versus some of the losses. And then you buy that stock 31 days later, make sure we avoid the wash sale rules. And what you can do is essentially reset that cost basis. So now the taxable basis from that stock maybe goes from $20 per share to, let's say, $60 per share. And so what that does is that's going to decrease future taxes. So if you have an investment advisor, I would strongly recommend you talk with them, review your positions, see if this strategy makes sense for you. But it's an excellent strategy in a bear market. The other thing that we want to begin to do is rebalance our portfolios. You know, we've seen the S&P 500 down as much as 25% year to date. We've seen the bond ag index down as much as 15%. So what happens is our ideal portfolio at the start of the year changes by the end of the year. So what we have here on the left right here is this is a model allocation in January of 2008. Okay, we have 25% in large cap growth. We have 25% large cap value, 10% small cap, 10% international, 30% fixed income. Okay. Well, this portfolio that is 70% stocks at the beginning of the year, by the end of the year, because the stocks underperformed in 2008, at the end of the year, you're now 60%, 58% stocks, sorry, 42% bonds. So what we want to do is we want to sell the investments to change them, to get them back to this normal allocation. Now, to do this in this example, if this was $1 million portfolio, we'd have to sell 34,000 large cap growth. We'd have to add 30,000 to large cap value. But you can see here, what this does is this helps avoid what's called portfolio drift. When you have an asset allocation model that you're trying to stick to, an investment plan, we just want to keep you as close to that plan as possible. So when things are bad, like this year, things like bonds tend to do better. And so what happens is that becomes a larger portion of your portfolio. But then when the markets kind of rebound, you're going to want to reduce that position so you have the better chance to have the gains going forward as the stock market recovers. All right, when we look at rebalancing portfolios, some of the advantages is it's a natural way to do some tax loss harvesting, selling some of those losses and locking in those losses to offset the future gains and reduce your taxes for this year. It's going to reduce your overall portfolio risk, giving you better potential for higher returns. If nothing else, it helps you maintain a very disciplined approach to your investments. When we're doing investments, we know that we don't want to make decisions based on emotion. So this is a simple way to make changes to the portfolio without having any emotions being involved. And lastly, it's going to encourage you to buy low and sell high. So things that have done well, you're going to sell and trim those positions. Things that have done bad, you're going to add more money to. That naturally is going to help you do this buy low, sell high, which we know is the most important thing when it comes to investing. Now, when you're doing this, you just have to be aware that you are creating taxes. There may be some trading costs involved. And if you're selling position and buying it back, we need to make sure that we avoid the 30-day wash sell rule like we discussed. So let's go ahead and move on to some income tax strategies. So Marilyn, can you talk about some of the life events that can impact someone's tax situation?
So obviously getting married, you have to decide whether you're going to be filing jointly, which normally is a better position than filing two single people, or filing, if you're married, you have to either file married filing jointly or married filing separately, which is usually a worse situation. Sometimes, for instance, in 2020, when at the last minute the government decided that you could exclude some of your unemployment up to a certain amount from your taxable income. And then we determined that there was a strategy that actually, if you filed separately, you could exclude double the amount of unemployment. And so a lot of people took advantage of that, and they did save taxes overall. So usually that doesn't happen. That was kind of a unique situation, but there are times when potentially married filing jointly or married filing separately may work to your advantage. In California, it's a community property state. So even if you wanted to file separately from your spouse, everything is split 50-50 because of community property law. So you pretty much have the same tax return, just split down the middle. So usually, unless there's some unusual transaction, it's not going to make sense to file separately. Obviously, divorce. For federal purposes, alimony is no longer taxable income, and it's no longer a tax deduction to the payor of the alimony. However, for California, they do not conform to that. So for California purposes, it's taxable income and it's a tax deduction. So that surprises people, because mostly they hear about the federal. Oh, I don't have to pick it up as income. Oh, I don't get to deduct it any longer. So you do have to be aware. And again, some people in other states, you have to look. A lot of people don't know whether their state is a community property state or a separate property state, and that affects tax planning also. So you should know what type of state you're in. You know, a child, you get additional deductions for child tax credits. Death, that was actually, Paul mentioned that you don't lose your capital loss carry forward. You actually do lose it upon death. So when a spouse dies, you could lose half of your capital loss carry forward. And then of course, self-employed. If you become self-employed after you've been a W-2 wage earner, you have different taxes to pay. You have the Social Security and Medicare tax that's normally withheld from your paycheck is now separately a tax line item on your income tax return, and you pay the employer's portion. It's a matching portion that currently as an employee, your employer pays the other half. As self-employed, you pay both amounts. And that comes up to about 15.3% of additional taxes. So you need to reach out if you become self-employed, or even if you're still employed and you have a side gig that you're doing something on the side, that you're aware of what the self-employment income and how it could impact you. We talked about the standard deductions and whether you have enough to itemize. Only if you have enough deductions to itemize that are total more than the standard deduction are you going to get any additional benefit. State and local taxes. So basically your itemized deductions are comprised of medical expenses, which you have to have more than 7.5% of your adjusted gross income in order to get over that hurdle, and anything above that is what's deductible as part of your itemized deductions. So that's why your adjusted gross income is important. The next bucket is state and local taxes, which now is limited to $10,000 since the Tax Cuts and Jobs Act of 2017, starting in 18, your state tax payments, your property tax payments, your car registration, total limited to $10,000. And we know in California, most people owe more than $10,000 in just state taxes, never mind your property taxes. Then you have mortgage interest, and then you have charitable contributions. So all of those need to add up to more than the standard deduction for you to get any additional benefit by itemizing. But don't forget, California standard deduction is a quarter of this. For California, married filing jointly is only about $9,000, maybe $9,500 this year. So when you say, oh, I don't need to give you, or I don't need to look at any of these items because they're all less than $25,000, that's for federal. California, you may have enough to itemize for California and possibly in other states. So don't forget to actually, if you're doing your own tax return, just fill out the itemized deductions, go through that exercise, unless you know for sure that your state has a standard deduction that's equivalent to federal, but California does not. So you would want to go through that exercise. Of course, we talked about the charitable contributions and how to maximize those. But again, you have to decide those in 2022 or before the end of the year, and to give your advisor enough time to do those strategies for you. Or for you, if you're just going to give it outright, whether you're going to bunch deductions, maybe you don't give in December, maybe you give in January. it's not going to feel that much different to the charity. So some people were worried about doing it that way. It's like, oh, the charity expects my money. Well, them getting it in January 2nd, when you write that check versus December 31st is not going to make any difference to them. And then you would just write checks again in December of that year to help bunch the deductions. Another way is a donor advised fund, and pretty much most entities that allow that type of an account, Schwab, Fidelity, Vanguard, there's all kinds of brokerages out there that have donor advised funds. You can open that fund up, you put your charitable contribution in that, and maybe if you have a large transaction, maybe you have a capital gain from a sale of a property, or you got a big bonus at work, you can put a larger amount into your donor advised fund and then decide later, next year, the next 5 years, where you're going to direct that fund to give your charitable contributions to charitable entities.
Yeah, and we'll cover the charitable gifts in greater detail in a few slides here.
Hey guys, real quick,
Yep.
before you move on, Paul, I think just because I think we talk about it, industry jargon, and it all makes a
Yeah.
lot of sense, but so just to make sure people are connecting the dots. I know I did type in the Q&A for one of the participants, but SALT stands for state and local taxes. I think in the industry, we just kind of, it's just jargon that we just kind of say over and over and over again. I think Marilyn actually said state and local taxes, didn't say SALT. And Paul always just says SALT, but that is the $10,000 that you see on the right hand side of the page. Thanks, group.
Yes. So basically, we'll talk about, since you mentioned SALT, we'll talk about that. If you happen to have a business that is a pass-through entity, that means an S corporation or a partnership. So in July of 2021, California and many other states, New York, New Jersey, many states have now adopted this workaround around
There's like
the SALT
20 or
deduction.
22 of them, so almost
Pardon?
half of them. There's like 20 or 22 states,
Yes.
so almost half of them.
Yeah, many states, and they're still slowly kind of getting on board to do this workaround, this SALT workaround, meaning on your individual tax return, if you owed $30,000 to California state taxes, and you have, $10,000 in property taxes and $1,000 in car registration or whatever, you're over the $10,000 and you only get to deduct $10,000. So that $30,000 you paid to California is basically non-deductible for federal purposes. So this workaround that the federal government has acquiesced, that said, states, you can do this, we'll buy into this. If you have a pass-through entity, only LLCs and S corps, the entity itself can pay your state taxes on your behalf. It's 9.3% of the net income or your share of the net income of that business. It will come out on your K-1. The business will pay the state tax. You will get a credit on your personal tax return. And the entity will get the tax deduction for those state taxes. So that same $30,000, if you had paid it out of your pocket as an estimated tax payment or withholding or whatever to California or to whatever state you're in, you don't get a deduction for it. If your entity pays the $30,000, then the entity itself gets the tax deduction for $30,000, which then flows through to you. And you've now saved, if you're in the 30% tax bracket, you've saved $9,000 of federal taxes. And all you've done is change the pocket that paid your state taxes. So it's a win-win. In 2021, when it was first passed by California, everybody started kind of learning about it and figuring out how to do it in November, December. And California had a lot of limitations on who could participate, limitations with AMT. And for some people, it didn't make sense. All of a sudden, in February of 2022, California said, okay, we're going to change it. We passed the law. We're going to take out those limitations. We're going to tweak it. We're going to do it a different way. And it kind of opened up the floodgates. So if you have your own pass-through entity, or if you're an investor or a partner in another pass-through entity that maybe you don't have control, make sure you're talking with the other partners that you want to opt in to have your state taxes paid through the entity. It cannot be done for an investment type entity, but if you happen to be in a real estate partnership, that real estate partnership can pay your state taxes. Again, it's a fixed amount. It's 9.3% of your share of the pass-through income. And they pay it on your behalf, and it'll come out and it'll show up on your K-1. But it's important. I had a new client who got a K-1 for almost $300,000. And I was like, oh, where's the pass-through entity tax? And the client had no idea what I was talking about. And this is an operating company. It's a restaurant. And she said, I'm just an investor. I said, I know, but they should have talked to you about the pass-through entity tax. And so I had some other questions about the K-1. I emailed the other tax preparer and they said, oh, we didn't bother with that. It was too complicated. And I said, well, what about 2022? Because in order to opt in for 2022, you have to pay $1,000 by June 15th to secure your position to opt in. He said, oh, no, we didn't do that. I'm like, I'm going to put you on notice right now. My client wants to opt in for 2023. You know, her 9.3% of $300,000, again, is almost $30,000. She's in the 37% tax bracket. She's now lost out on 2 years worth of the pass-through entity tax, which again, is just the entity paying your state taxes out of what distributions you would have gotten. Your distributions are going to be less because they're going to take your money. It's not that they're going to take their money. They're going to take your money, which would have been your distribution. And instead of you getting the distribution from the entity and then you paying your state taxes, they're just going to pay some of it directly on your behalf. So kind of keep that in mind and check with any investments you may have or your own accountant related to your own pass-through entity. So a few other things besides related to businesses, besides the pass-through entity tax, home office deductions really only work now for Schedule Cs or possibly LLCs. The deduction for a home office for an employee on your federal return is no longer allowed. It was a 2% miscellaneous itemized deduction, and that's gone since the Tax Cuts and Jobs Act. New equipment that you need to purchase, bonus depreciation is 100% write-off of any new equipment. Starting in 2023, it goes down to 80%, and then it goes down by 20% a year until 2027 when it's completely gone, unless it gets renewed.
Just a quick side note, we did a recent blog post on this topic. So if you are a business owner considering buying new equipment, I would strongly recommend take a look at the notes. So look at the chat, and Chad will be adding a link for you guys to read that blog post.
Okay. The same goes for if you're going to purchase an auto before the end of the year. If it's a passenger vehicle, less than 6,000 pounds, there is some bonus depreciation. It's limited. It's, I think, $18,000 or $19,000, and then you depreciate the rest of the vehicle as normal. However, if a vehicle is more than 6,000 pounds, you do get 100% of bonus depreciation on that, subject to your business limitation. So if you're only going to use the vehicle, first you have to use it more than 50% for business. And so if you use it 80% for business, you're going to be able to take 80% of the purchase price and completely write it off on your taxes against your business income. Retirement plans, most businesses, you can make contributions up until the due date of your individual tax return, of your entity's tax return, and all the way to the extension date. The only time you're limited on retirement plan contributions is with IRAs, Roth IRAs, traditional IRAs. April 15th is the deadline. That's the end of that. So, but for business related retirement, you've got options of solo 401ks, 401k plans, profit sharing, defined benefit plans. There's a lot of retirement options out there for businesses. And then we talked about charity, obviously deferring revenue or accelerating revenue, whatever works best when you plan for the year. The other thing is the qualified business income deduction. That is a new law starting in 2018 as a result of the Tax Cuts and Jobs Act. And there are some exclusions that some businesses, people in the health business, doctors cannot take the QBI deduction unless their income is below a certain amount. Accountants can't do it. Attorneys can't do it unless their income's below a certain amount. So that's definitely a planning strategy that I think has kind of fallen by the wayside a little bit. I don't think people are planning for the QBI deduction as much as they should be or could be, which is potentially having to maximize your salary in your business and or reducing your salary because you want more net income. So there are tax planning strategies with businesses related to the QBI deduction, which is important to look at.
Absolutely. Now, one thing that you need to look at when it comes to the tax withholding, you have to pay either 100% of prior year's tax liability, 110% if your AGI is greater than 150,000 by January 15th, or 90% of your current year tax liability. You have to meet one of these two payments by January 15th to avoid any sort of penalties. Now, for California residents, if your income is greater than $1 million, you must use option 2, which is paying 90% of current year tax liability. You're not eligible for the 100% of prior year tax liability. Again, if you're a California resident with income greater than $1 million for your California return, not the federal return.
Correct. And, you know, it's also important to talk to your accountant about your estimated tax payments, or when you have a transaction that for California may put you over that limit, because then, I mean, when he's talking about penalties, the underpayment penalty is really interest that you owe. But if you had a transaction back in March that caused your income to go over $1 million, you should have paid extra taxes back in March, not now. That's the 90% of the current year. Both California, well, and federal, they want their payments quarterly. If it's done through withholding, that's assumed to be done ratably throughout the 4 quarters. But when you make an estimated tax payment, the IRS or California knows exactly the date that, because they have to record the check or the online payment. So it's important because sometimes penalties are a few $1,000s.
I'm so sorry to cut you off, Marilyn. For sake of time, we're going to speed up just a little bit here. So we're going to skip a few slides along the way, guys, because we want to honor your guys' time. Thank you for sticking with us. When we're looking at the tax brackets this year, if you have a higher than normal income year, these are some of the things that you can do to help with the tax situation. You can increase your retirement plan contributions because everything you put in is a tax deduction. Accelerate your charitable gifting. Avoid capital gain recognition. This year, recognize more of the losses. We want to take advantage of deferring payments as well from retirement accounts. Now, if you're in a lower tax year, maybe you got laid off this year, or maybe you or your spouse did, so your income is lower than it would normally be. This may be a good year to do things like accelerating income recognition, whether that's doing a Roth conversion or exercising stock options. If you have lower tax or lower taxable income, maybe defer your charitable giving to a year that you have higher income. Avoid capital loss recognition. This is actually a good year to recognize some of those gains. So if you're in a lower tax year, that step up in basis strategy that we talked about earlier, this would be a good year to do that. And delay expenses for your business. Now, when it comes to tax planning in a bear market, these are some of the main strategies you're going to want to consider. We've talked about the tax loss harvesting. If you have losses on your portfolio, work with your investment advisor, lock in those losses. If you have a down income this year, so not as much income as you normally would, this is a good year to consider exercising stock options. One, because you have lower income tax potential. Secondly, the value of the stock may have come down for the stock option. And if that does, that allows you to exercise more options than you may have otherwise done if it was at a higher stock price. Delay, if you turn 72 and if this is your first year for RMDs, you can delay the RMD collection until April. So that may be a good strategy for this year. Consider your Roth conversions. Consider making contributions into 529s. The stock market is down this year. We don't expect it to stay down this long forever. We do expect it to rebound. So making contributions into a Roth account or a 529 when the stock market is down, when it recovers and you get all that gain, now that gain becomes tax-free in a Roth conversion or a 529, as long as the 529 is used for educational expenses, of course. Make sure you're contributing to your health savings account, known as an HSA, if you have one through your employer. We talked about resetting your tax basis, and then make gifts to your family. So maybe you're not struggling, but maybe other families struggling, making gifts to them. This could be done with appreciated stock. So if you have stock that has large gains, instead of you selling the stock and having to pay the taxes on those gains, you can gift that stock to a family member. Then that family member can go turn around and sell that stock. And if they're in a lower tax bracket, that's going to be lower taxes paid on that gift. So for example, I have one client that we've done this to help pay for their kids' college education. Instead of them selling the stocks and realizing the gift, their son doesn't work. So they're gifting the stock to their son. He's selling it at a zero long-term capital gains tax rate. And then he's taking that money to pay for his college education.
So one caveat on that, kiddie tax does apply until age 23 now. It used to be just until age 18, I think. They raised it to 23. So sometimes that doesn't exactly work. Because that means the kiddie tax means the kids have to pay taxes at their parents' tax rate. So if their parent is in a high tax bracket, so you'd kind of just have to watch that kiddie tax. But yeah, that strategy does work too.
Okay, so a good way to help lower your income is to make contributions into maybe either a traditional IRA to get that tax deduction, or if you're just trying to grow, you can make contributions into a Roth IRA. There are some income limitations if you're going to qualify to make contributions to these accounts. For someone filing single, you cannot have income higher than 73,000. If you do, you have what's called a phase out, which means instead of being able to contribute the full 6,000 for this year, it's reduced, okay, from 73,000 to 83,000. If you're married filing jointly, if there's no one else that's an active participant, if one spouse is an active participant, meaning one spouse is contributing to their employer-sponsored retirement plan, like a 403B or 401k, that limit is 218. If both spouses are contributing to their employer-sponsored plans, that income cap becomes 116,000.
So there's the income limits also for the Roth IRA. And I think the biggest place where people are missing out are not contributing to Roth IRAs when they have the option to, especially when you're looking at, you know, a single person to 144,000 or a married filing jointly to 214,000. It's best to try to, because your Roth IRA contributions have to be in there for at least 5 years. So it's best to try to start the Roth IRA as early as possible. But I just see a lot of people missing out on doing Roth IRA contributions when they can. So keep an eye on that.
So we've talked about Roth conversions, why they can be a good strategy. They can be a good strategy because you are moving money from a tax deferred account to a tax-free growth. And now that money's growing tax-free for the rest of your life, Roth IRAs are also not subject to what are called required distributions, or RMDs for short. When you turn 72, the IRS requires you to begin taking money out of your tax deferred account. So your traditional IRAs, your 401ks, your 403bs, things like that. The Roth IRA is not subject to that. But if you're going to consider a Roth conversion, it's best to do it when you're in lower income years, because the amount that you convert is subject to income taxes in the year you do the conversion. So if you convert 10,000, now you've added 10,000 in income for that year. Okay. Distributions before 59.5 are subject to an IRS withdrawal penalty. So we want to do this when you're older than 59.5. They're not subject to RMDs. They're not subject to the RMDs like we talked about. And any portion can be converted to a Roth. It's not an all or none strategy. You can do any amount to a Roth conversion. And so we'll do typically with a lot of clients what I call a fill the bucket approach. We'll take you up to the top of your tax limit. So let's say you're in the 12% tax bracket. We'll take you to the top of the 12% without bumping you up to the 22%. That typically becomes a very good way to make Roth conversions over time in a more manageable process without really increasing your tax load.
Just to expand upon the Roth thing, kind of going back a little bit. If you're over that income limit and you have no other IRAs, all your money is in a 401k, you have no IRAs, what you can do is do what's called a backdoor Roth IRA, which has not been eliminated yet. Biden was trying to eliminate those in his tax plan, but that has not passed. That's not on the table at the moment. So you can contribute to a non-deductible traditional IRA and then immediately convert it to a Roth IRA. So that's called a backdoor Roth. It does not work if you have other IRA accounts, because the reason it works is because you have basis, because you've never taken a tax deduction for the traditional IRA contribution that was non-deductible. So you have basis in that IRA. So when you convert it to a Roth, it's not taxable because you've never taken a tax deduction. If you have other IRAs that have never been taxed, it doesn't work. So.
Perfect. And then the last topic here is going to be charitable gifting and legacy planning. And we have touched on this a lot. When it comes to charitable gifting, you can make gifts of either cash or stock. Giving stock is a great way if you have stock that has large gains, because if you gift the stock, like we'd mentioned before, you don't have to sell it, and you don't have to lock in and pay taxes on those capital gains that you would otherwise have to do. When you're giving over time, if you're someone that is charitably inclined, looking at the donor advised funds is a great way to do that, because it allows you to give a lot of money up front. That money can be then sitting in the account invested, and then you choose when and how over time to give to charities. And this is a great strategy if you have a windfall year. So if you have a large capital gain from the sale of a home, if you have situations like that, talk with your tax professional or your investment advisor about possibly using a donor advised fund to help manage your taxes in a windfall year. The other way that you can do is you can make gifts to individuals, to family members. Okay, so right now the limit is $16,000 per donor per year. So a married couple can each give $16,000 to each of their kids. So if they have 3 kids, each kid can receive $32,000. So a married couple with 3 kids can gift a total of $96,000 without even triggering any sort of gift tax filing return. Now, if you are trying to get around estate taxes, this is an excellent strategy to help your heirs in doing that. And when you're making these gifts, you can give it to the individual outright via cash or stock. Or if this is maybe for a grandchild, what you can do is gift the money into a 529. And with a 529, you can actually front load that 5 years. So you can make 5 years worth of gifting in 1 year. So if you're trying to get money out and avoid estate taxes, 529 is an excellent way to consider doing that.
Also, make sure when you're making those annual gifts that you write the check and it clears in the year that you're making the gift for. Because a lot of times people give it to them in December and then the kids don't cash the check and then it gets cashed in January and they want to do it again the next year or maybe in the middle of the year. And then that drops it into more than $16,000 in 1 year. So the check should cash before the end of should clear your bank before the end of the year.
That's an excellent point. Thank you for mentioning that, Marilyn. That is everything that we have here. We'll move to questions in just a second. Chad, can you go ahead and take over?
Thank you so much, guys. Awesome presentation today. So I did just post a couple links in the chat box. One is a link to a survey. Let us know your thoughts and future topics that you all would love to hear, as well as a link to the slide deck from today's presentation. So if any of you want to download the slides, click that link. It'll be a soft copy available via PDF. With that, we do have a number of questions. Go ahead.
Oh, sorry. Paul. Yeah, real quick. If please review the slides, guys. We did skip a few of them just for the sake of time. If you have any questions on them, please don't hesitate to reach out. We're happy to discuss any items that we skipped in today's presentation.
Yep. Awesome. So then, getting to the questions, as a reminder, there's a Q&A box. Please do type any questions you have into the Q&A box. We will continue to answer them for as long as we do have questions. But getting to the first one that is a few thumbs up is really just thinking about capital losses and carrying them forward. How long can you carry those losses forward? Like, is there a cap or a time limit other than death where they would expire?
There is no time limit for capital loss carry forward.
It's basically indefinitely until your death, basically. So your heirs don't get to carry your losses forward forever. Correct. Awesome. So next question that I got a couple thumbs up is for the additional 65 plus married deduction. Does that work if only one of you is 65? Say my spouse turns 65 this year.
You get on the standard deduction, you get an extra $1,400 for each person who turns 65. Yes, it's by person. And you also get an extra $1,400 standard deduction for each person if you're blind, if you're legally blind. And there are people who are legally blind, they're not totally blind, and they do get the extra deduction for that.
Yeah, great answer. Next question here is when itemizing deductions, is mortgage interest also capped based on AGI?
Mortgage interest is not capped based on AGI, but there is mortgage debt limits now. So after December, if you've bought your house after December of 2017, then your mortgage interest debt limit is $750,000. If you bought your house before December of 17, it's limited to $1 million. It used to be $1.1 million, but now it's $1 million. And so that's grandfathered in, but you have to be very careful about your refinances. And there's limitations on that. And especially when you take money out, that's another thing that people don't realize on the mortgage interest, that you don't get to use your house as like a piggy bank for IRS purposes. You do get to use it like that for whatever you want to do. But for IRS purposes, they require tracing of any money that you take out of mortgage. So if you refinanced, took out an extra $50,000 just to pay off credit card debt, $50,000 of that mortgage debt would not be deductible because it's traced to a personal expense. So it's considered personal interest.
Yep, thank you. So next question is, somebody just downloaded the slides and there's a slide that, Paul, you skipped. Would you mind going to slide 23 and talk through the example of a Roth conversion? I think we have another question on Roth that'll come up just next as well.
Okay. So this is taking a look at doing Roth conversion over time. This is from an actual client that we worked with. But what we can see here on the left side with us doing the Roth conversion, what ended up happening at the end of their life, they ended up with 1.29 million in a traditional IRA, but 1.7 million of it was in a Roth IRA. So this $1.7 million is not subject to taxes, and their heirs receive this money tax-free, where their heirs are going to have to pay income taxes on this 1.29 million number here. If we don't do the Roth conversions, what we find at the end of the plan is instead they have 2.4 million in a traditional IRA that is all subject to taxes for their heirs. So instead of their heirs getting 1.3 million taxable, the heirs are going to get 2.4 million taxable. And this is just a regular joint account that's a taxable account, had about 724,000 left. You don't see this in the first example because we spent it down trying to let that Roth account grow as long as possible. But what we want to show here with doing the Roth conversion is, although the amounts, if you add them up, are pretty similar, the tax implications are huge, because this 1.3 million is subject to ordinary income taxes, where this 2.5 million is subject to ordinary income taxes. So it just shows you the advantage of doing the Roth conversions over time. It's an effective strategy to grow your wealth potentially, and it's an excellent tool for estate planning if you're trying to pass more money on to your heirs.
Yep. Thanks, Paul. Next question we have, and this also is about Roths. My CPA had me open a backdoor Roth for both me and my spouse. However, I do have another simple IRA that I have at Vanguard. Is it a good idea to keep contributing to the backdoor Roth? We are both over age 65.
So this question we would have to pretty much answer offline. There's more that we need to know about your individual situation to really be able to answer this. I would say this. I have clients that make over $1 million a year that we're doing the backdoor Roth contributions for them because their tax brackets are never going to change. Maybe they have a really large pension or whatever the case is. So there are times where it makes sense to lean into doing a backdoor Roth or doing the Roth conversions, even if you have a really high income tax bracket.
Yep. Thank you, sir. Next question, and I think this one might actually be a good one for next week too, when we're talking all about Medicare with a Medicare expert. But it says, if your spouse turned 65 mid-year and you were on a medical plan with HSA and they enrolled in Medicare mid-year, are you still able to contribute up to the family HSA limit for the year? I am a subscriber to the plan. He is still on my insurance.
So as long as a spouse is still working and they are not on Medicare, they're still on their employer-sponsored healthcare plan, they would be able to make the contributions to the HSA. But this is definitely something that you're going to want to listen to next week, as our Medicare expert will go into this in great detail.
Yeah, let me expand on that, because this person added a secondary piece that they're also looking to understand it from a benefits enrollment this year. They plan to keep the spouse on the insurance for 2023, even though he's on Medicare. HR told them that it's about the subscriber and that is not him, so I can still do the family limit. I just don't want to be penalized. So
okay, there's different types of Medicare. It's Part A, Part B, Part C, Part D. And so it's really dependent here on which parts of Medicare they're going on and which parts they're not. Please tune in next week. I'm not trying to kick the can down the road here, but we're going to have Brian MacArthur on. And there's no one in this industry that I know that has as much knowledge as he does. So I would strongly recommend save that question for next week.
yep. Guys, and then this is actually, as of right now, the last question, unless any more come in. Do you guys know, is there an income limit for 401k rollover to Roth IRAs?
For a Roth conversion, which is where you're taking money from a tax deferred account to a Roth account, there is no income limitations. Those income limitations only apply if you're trying to make contributions to a Roth account while you're still working.
Yeah, I think an important thing is we talked a lot about Roth conversion, especially for people that are still working, is it is a irreversible decision. So especially thinking about if your 401k and you can move it to if say all your 401k is pre-tax money, and you could roll that over to a pre-tax IRA when you retired, or leave that employer. If you were to move it to a Roth IRA and do a Roth conversion, you definitely want to work with your accountants, because you cannot reverse that decision, but you also can't use the pre-tax 401k money to pay the tax bill. You're gonna have to come out of pocket for that. So say you're rolling over a $50,000 pre-tax 401k, you move that to a pre-tax IRA and then convert it to a Roth IRA, all $50,000 becomes taxable today, but your Roth IRA is gonna have a $50,000 balance that you cannot distribute to pay that tax bill. So you definitely want to think through the tax ramifications and make sure you have enough cash on hand in your bank and savings account to pay that tax bill out of pocket.
Yeah, definitely work with a tax planner if you're looking at doing a Roth conversion.
Awesome, group. So that was, again, our last question. Any closing remarks as we wrap up today?
Thank you. And I hope this prompts you to start planning before the end of the year and reviewing last year's tax return, making sure you understand. You don't have to understand the tax laws. If you just look at the numbers on your last tax return, you'll see what your AGI was. You'll see where your taxable income was, and then you can ask questions of your tax accountant or so that you can just understand. You don't have to know the tax laws, just have them explain where you are, what you could do differently to maybe change those numbers around.
Awesome. Thank you so much, group. And again, reminder, tax planning is a year-long thing. If you wait until April, you did not do a good job tax planning. Last remark, group. Thanks everyone for the presentation. I hope everyone has a great day.
Thank you. Bye.
You too.